How high is too high? We're going to talk about that ahead of Broadcom's earnings, which they're going to be reporting tomorrow after the close. Talk a little bit about UnitedHealth and see if we can address this unusual whales issue today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. In a cautionary tale about exceeding one's limits and perhaps ignoring the cautionary warnings of one's father, in Greek mythology, Icarus, the son of Daedalus, perished after flying too close to the sun, melting the wax that held the feathers on the wings that his father had made him. The authors of that story, of that myth, probably had no way of knowing, unless they were also really into mountaineering and had hiked up, say, Mount Everest, that actually the threat that he likely would have faced would not have been too much heat, but too much cold as he went up, considering that it's about 40 to 70 degrees below 0 Fahrenheit at the altitudes where jets travel, let alone the cold vacuum of outer space. What has me thinking about this, though, is Broadcom, because somebody asked about it on Monday. I commented that I do like Broadcom going into earnings, which they're going to be reporting after the close tomorrow. And the stock actually hit a new all-time high yesterday. It hit another new all-time high today. That was not earnings related. I would really say that was related to two things. So the first of those was that the company announced that they are going to be shipping their new breakthrough chip. Now, of course, when people think about artificial intelligence and the technology requirements, mostly people are thinking about NVIDIA, which makes the GPUs that are central to a lot of these big hyperscalers' data centers. The thing is that those GPUs rely on other hardware to network together. So when you have these really big data centers, let's say 100,000 GPUs, it isn't just necessary to have powerful GPUs, but that information is communicated to and from them quickly. I was surprised to learn, and only did after Broadcom made the announcement that they were sending out their new chip, that those GPUs are typically utilized at only about 30 to 40% capacity. And so that underutilization is a big, obviously, it's an issue and it's an opportunity. And their new switch chips, which apparently can do the work of 6 of their predecessors and cost about twice as much. So they said they would not charge more than $20,000 for these things. By the way, these switch chips, they need one of them, I guess, for every 10 GPUs. But essentially what you're doing is you're offering your big customers the opportunity to get much more out of the GPUs that they already own or those that they intend to buy. So to improve that utilization. This is a big deal. And when you combine that with the announcement that Meta made yesterday, that they had signed a deal with Constellation in Illinois. So Constellation operates a nuclear power plant there. They're going to build a new reactor, and Meta contracted, they did a 20-year deal that begins in 2027. That is going to be used to power one of their AI data centers. It's pretty clear that the runway for this is quite long. So all of that is really good news. And I thought that it made some sense as we look at this, though, to also remember that as good as that is, I just wanted everyone to have a little bit of context on the price to forward earnings. So we know that the stock's at an all-time high, but what we really care about is what its valuation is. And so I have here the price to sales and the price to forward earnings. Now, I'm going to just back this off for 1 second because I want you to observe something. So the price to forward earnings is actually as high as it has ever been. I don't know if you can see this right here. I'm pointing to it with my cursor. So it's about 40 times forward earnings, and it's trading around almost 23 times sales. Again, both of these are at or are all-time highs. The reason I'm pointing this out on this shorter chart is because when I blow this chart out, what happens is the way Bloomberg does this, it sort of lumps all of this stuff together sometimes. So if I go to max, no, it's still showing it correctly here. Okay. Sometimes what will happen is it actually brackets various quarters, and it'll show the average for a quarter or something like that. So I just wanted to give you guys some context, though. So these are 15-year numbers. And actually, I don't know, for people who have watched this channel for some time, you may remember, I just want to give some perspective here. So that's the line where we're at right now in terms of price to earnings, forward earnings, that is, which I expect to go up, actually. And that's the price to forward sales. So 22 times sales. So I expect these numbers to go up. What is interesting, though, I thought the timing was kind of interesting, that they would release this information just days before earnings. So in any case, when I was asked about this, because somebody I think mentioned on Monday's show that they were long an in the money call spread. It might have been the 250, 280, if memory serves. And I was pointing out that if we look at unusual whales, we could see that the options were reasonably priced. I still think that's true. I will tell you that if you were thinking about owning this stock going into the print, you know, there's just so much good news. I was looking at this out of the 51 analysts that Bloomberg tracks that cover the stock, 46 had buys, 4 holds, and 1 sell. And in the hold category, that included Morningstar and Zacks. And Morningstar and Zacks are, they're not doing the same kind of fundamental analysis as, say, Goldman Sachs or JP Morgan or somebody like that is doing. They have templates for reasonable fundamental valuations. And it's not uncommon to see growth stocks sort of fall by the wayside in terms of the recommendations of Zacks and Morningstar based on their formulas, just saying that, you know, the valuation multiples get a little bit extended. So they tend to trail a little bit when the earnings estimates or the sales estimate growth is underestimated, relative to that. But anyway, I just wanted to point that out and just go quickly here to earnings, because my own take on this is that if you are inclined to make a bullish bet on Broadcom, if you already own it, maybe consider a put spread collar just because it's had such a run. This actually also illustrates this. These dotted lines here indicate the historical performance of Broadcom going into earnings, and this indicates the performance that we've seen recently. Part of that, of course, is due to Liberation Day. So Liberation Day tariffs, stocks rolled over hard. Broadcom was very hard hit. But since those lows from the first week of April, Broadcom is up over 75%. So, we've had a big move in less than 2 months. Okay, so here we can take a look at the earnings moves. We can see that many of their earnings-related moves have been bigger than what the options market implied going into the event. The one that we have right now is about 6%. That's the one-day move. A little bit bigger than some of the earlier ones here, but still substantially smaller than pretty much any of the earnings-related moves that we've seen recently. And again, stock has had a big move recently. So just consider, if you're in the stock, maybe you can do a put spread collar. Don't have to go out too far. Maybe put this thing on for nominal cost. I wouldn't necessarily suggest a zero cost. Look to mute a little bit of the downside. Give yourself about 10% of upside 30 days and in. So why don't we just structure one of these things really quickly so you guys have an example. The other thing is that I did contact Unusual Whales, and they gave us some steps to follow, which I'm going to go over in a second, so that if you were one of those people that tried to subscribe to Unusual Whales and use the coupon code and it didn't work, apparently there's a couple things that you do, and they're working on simplifying the process, but I'm going to walk through that in a second as well. All right, so I'm just going to start with this one here. We're just going to assume that you own the stock, and we're just going to add a couple of puts and a call option. We're going to buy these puts, And again, this is not to get perfect protection, perfect hedging, anything like that. Really, the objective here is just to mute some of the potential downside. It doesn't even have to be out that far. Maybe just go out 30 days just so that the thing monetizes fairly quickly. So we're at 261, 250, maybe 220-ish, 225-ish, something like that. So own a $30 one, and then we're going to sell an upside call. It doesn't have to be zero cost because, like I said, options are very reasonably priced. And you want to give yourself some upside, at least 10%. Something like this would mute the impact if it doesn't turn out to be as good as everybody is hoping for and expecting. And again, here this is where you can really see the move that this thing has made. I mean, this thing was down I think it actually ticked into the high 130s. Certainly the low 140s at one point back here in April. And we're up $100 plus since then. Okay, so that is that. Very quickly turning to steps to follow if you were trying to subscribe to Unusual Whales. You click this pricing and billing tab under the settings, and then you select the plan that you're interested in, I guess. And the key is to make sure that they enter in open interest, all one word, all caps, into this coupon field, and then you should get the discount reflected here when you get to the next section. So I hope that helps anybody who was having troubles with that. Okay. One other thing that I thought was interesting and that we might want to take a look at is UnitedHealth, because obviously this is a company I've mentioned it more than once that I know somebody who works there. Mark Guthner and I used to work with her. She used to be actually the head of research at CRT Capital. And I mean, I just want to sort of highlight that if you didn't see it and you have access to it, you probably do want to take a look at it. I think it was in the Wall Street Journal. There was an interesting article that talked about the tenure of Whitty, that's the CEO that just stepped down. And then Hemsley came back and took over again. And it was interesting. It was an interesting read. And I'm not sure, I'm going to find out. It might, if you don't have a subscription, I'm not sure. I might be able to put an unlocked gift article into the description for this. So I'll see if I can do that afterwards. So for anybody who doesn't have access to it. What was interesting about the article, though, to me was, and this was something I did not know, was that when Whitty was CEO, so he lived in London, and he was splitting his time between London, D.C., where he has a house, and then periodically at the company's Minneapolis headquarters. And it's my understanding that, among other things, he brought some of his former fellow executives from his prior role at Glaxo with him to the new role, and that this team may have had somewhat less experience with the insurance industry than the people that preceded them. And that may have contributed to their decision essentially to go wholeheartedly into this Medicare business that they went into more aggressively than some of the other managed care providing companies did. I'm talking about the Medicare Advantage plans and things like that. The ones which, it turns out, now have higher payouts relative to their premiums collected than they anticipated. So these are the situations where the expenses associated with these customers, which they had been adding so aggressively, ended up being higher than they had modeled. So a couple things I would say. One, Hemsley coming back, I mean, he led the company to remarkable growth, and he obviously does know the industry. So If there is somebody to come and fix some of those issues, presumably he would be a very good candidate to do that. There are some other bits of news, though, that were a little bit concerning in this story. For example, we have the allegations that they may have overbilled and things like that. My thinking here, and as many will know, I had promoted selling puts down at the 280 and 250 strikes. The stock obviously is above that now. I'm not really anticipating that the stock is going to recover back to these prior highs that we're looking at on the screen right now. So my sense of it is, if you're inclined to make a bullish bet, I'm going to have something similar to this on small rather than owning the stock. I'll probably have some, swap out to some call spread risk reversals. So I have a little bit more of a buffer, and just look for modest price appreciation here while they uncover the things that have been going on. So because I had brought this stock up on more than one occasion, some of those things were a little bit news to me. I also have to say that I'm not enamored, and I was disappointed to read it actually, of situations where the people who are running the company are so far removed from the company's headquarters and from all of the people that are working there day to day. I'm not sure how you really get a good sense for a business, particularly if it was not your specific industry, by trying to manage that business from thousands of miles away. Again, that's not Hemsley's issue. Apparently, as some of these things were getting uncovered, obviously he's a big shareholder, previously run the company. Apparently he was really in there and digging into things to figure out what was going on. So I would have every expectation that whatever's going on, he'll be able to fix it. But, we're dealing with government contracts. We're dealing with millions of covered individuals. These are problems that will almost certainly take a little bit of time to resolve. Okay, so just wanted to get that out there as well. Okay, let me see here. I'm going to just go into my... There it is. All right, let's take some questions. All right, Jim Howard, how do you manage your watch list and actionable thresholds? So, good question. The watch list, so you know, is something that I tend to refresh pretty regularly. And what I mean by that is I'm always looking to see, a couple different things. Let me see if I can find an example of this. So in the context of Broadcom, for example, today, one of the things I was interested in was, let's see if I can pull this over. So this is, I don't know if unusual whales are, I'm not sure what services offer this, but in any case, pairwise correlations, one of the things that always interests me is, okay, what stocks are most closely correlated to one another? So if I'm looking at Broadcom, for example, and I, of course, brought up the wrong sheet. Well, maybe it doesn't matter. I'll tell you which one it was. This is a different correlation sheet. But basically, we do pairwise correlations and just look to see, what companies' stocks are most closely correlated with one another. And then I will look to see which stocks seem to have disconnected more recently, and then try to discern whether that disconnection is a result of a fundamental shift or something else. Now, one of the things you will see is, because this is doing ticker by ticker pairwise correlations, it should come as no surprise that the most closely correlated is Alphabet to Alphabet. This is not, now it's comparing symbol to symbol. So you'll notice that Google, with an L, the voting shares, versus Goog, the non-voting shares. So there's two share classes, but obviously they track very closely together, almost one-to-one. Next one here, Liberty Global versus the Class A Liberty, again, tracks very close to one-to-one. So you're going to see that. Here you have the Carnival American Depository shares versus, the regular U.S. listed stock. Again, very closely correlated. So every day I'll typically go through. Well, I'll go through my screening process, which is when I go through. I think I've shown you guys this before. So I will look for underperforming stocks that meet certain criteria. Not really, and admittedly, sometimes I'll tweak this a little bit depending on what my growth expectations are for the broad economy. Oh, that's a very good point. I'm going to get to someone get in my ear and remind me to come back to the growth forecast and the dean of valuation. So basically, every day I'll go through the same things. I'm looking for stocks that are beat up. I'm looking for stocks that have, as I've pointed out, are growing, because I'm usually looking for companies that, not growth stocks per se, but are growing at least as fast as the economy, that are trading at an attractive multiple. And then I'll just sort of filter through it and I just scan it every day rather than just looking at the same list. Usually the same stocks come up, but by doing that screen every day, if something new pops up or if some other pattern emerges, I'm more likely to see it. So just sort of by rote, go in, do your process. Now, I'll grant you, if you don't have something that allows you to filter really quickly, then you probably do need to look at it a little bit differently. But, sometimes I'll see a new name pop up. I mean, a lot of times things that do meet a screen aren't necessarily investable because I might have already dismissed them for some other reason. But seeing them again and again and again, it'll always come up because I'm not ruling them out because they're still falling into that screen. It's possible that the underpinning fundamental reasons why I might not have liked it for the last few months might suddenly be changing, right? So what would be an example of something like that? Let's say I was looking at Delta Airlines. I mean, I like Delta Airlines. And the stock had gotten beaten up, and I think most of the things remain strong for them. But let's just say, for the sake of argument, that I did like Delta Airlines, but the reason I didn't like the stock at any given moment was twofold. All of these airlines were renegotiating their contracts, and so you might have been concerned, for example, that the wage hikes were going to be too steep because their two biggest expenses are going to be wages and fuel, and the other might have been oil prices. So if I'm always screening and, day after day I look at it like, no, I didn't like that because of the union contracts, and no, I didn't like it because of oil prices, and then all of a sudden, it pops up on my screen, 120 days later, and the contracts by now have been signed and oil prices are 20% lower. I'm going to say, okay, well, you know what? Maybe now it makes sense. So I hope that helps. So basically what I do is, and this is not a convenient process. It would be easier, admittedly, if I just had a watch list and stuck to it. One of my former colleagues, he does something that I can't do, but I'll describe what he does. And the first time I saw his screens, I thought, how do you do that? And he's a great trader, by the way. I mean, he's one of the best investors I know. He has 300 symbols on his screen, and it's just the tickers grouped by industry and their price and the percentage change, and green if it's up and red if it's down. And it's just basically, he's looking at the matrix. He has one screen and it's got 300 symbols on it. That's it. And I asked him, I said, how do you do that? I mean, what is that supposed to accomplish? And he said, well, these are 300 companies that I know them pretty intimately. He's obviously not invested in all of them all the time. But what that does for him is that because he has it grouped by industry, at least the way he describes it, he gets a sense if there's a shift going on. And that an industry is starting to either roll over or catch a bid, that kind of thing. And because he kind of knows the symbols anyway, he's really just looking for money flows to see whether that supports it. He's a deep dive guy. This is the guy who worked for at Ivory Capital. Ivory had a sort of a deep dive private equity approach to investing. These guys were all former bankers. They were not technical analysts. I'm not putting a knock on technical analysts, by the way. I think Carter Worth actually started at Donaldson, Lufkin, Ginrette. Oops. How about that? Is he watching? Carter, are you watching? He's calling me right now. I'm sorry, you have to go to voicemail. So, yeah, I mean, I guess everybody's going to have a slightly different approach, but that was also an interesting approach, I thought, and one that has value, but everybody's going to have a slightly different process. People who are focusing on technicals, I know what his process is. He also does this every Sunday. He goes through something like 500 symbols every Sunday night. He goes through them. Again, everybody's going to, but that, and he does it without the ticker symbols, without a description, because what he's trying to do is just make sure that he's looking at it with fresh eyes and he's not bringing in any, sort of preconceived notions, if you will. LULU, Alex V, that's tomorrow. Expect some weakness or not. Consumer discretionary, such a tough spot. I should ask Holly right now, is this still on her? I mean, she's, this is a Holly index name. Let's just take a quick peek. So we're right at this critical level. I don't know if you guys can see that. I hope you can. But we're basically right at the 150 here. Not an expensive stock. Okay. So let's just bring up the same chart I was looking at before in the case of Broadcom. 22.3 times forward earnings. I like the demo that they serve. We're looking at only modest year-on-year growth. Let's see what the quarterlies are. Yeah, so the pace of growth has certainly slowed. This is a little bit troubling. I don't know if you guys can see this real well. So this number that I'm pointing to with my cursor, let me see if I can blow this up below. So these numbers, we were just talking about screening, right? Things that are on your list and off your list. I don't have a position in LULU at the moment. I should point that out. Why not? This is the problem. Let's see if I can... You know what? Last time I hit this button... Oh, okay. That seemed to work. So let's just highlight this. So the numbers that I'm trying to draw your attention to are these ones down here, the 5.3 and the 2.72. Okay, what are those numbers? Those are the growth numbers year on year. And what have I said historically? That for a company to get on to, because there's a lot of great companies, a lot of great large cap companies. There's 1,000 companies in the Russell. To justify a position in the book, I want to know that it's going to outperform the S&P. Now, this is trading cheaper than the S&P, which is 24, 25 times forward. This one's about 22.5, but not a whole lot. Not a whole lot. It's about 10% cheaper, which isn't that meaningful. And what have I previously said about S&P growth? I expect to see top line growth maybe 100 basis points, 150, 200 basis points better than GDP growth. So if we're seeing 2.5%, 3% growth, I expect to see the top line growing 4.5 to 5. That's because the winners filter to the top in this, and generally because of operational efficiency improvements, winners being winners, Nvidia getting 53% after-tax net income margins, that the bottom line will grow even faster. And so this one sort of fell off for that reason. If you own it, and of course there are tax consequences, I'm not going to give you any tax advice. If you own it, I still like the company. I still like their products. My wife still buys them. So all of that's good. But you combine the fact that consumer discretionary is just a really tough spot to be in. The growth has slowed. They've seen some increased competition. I'm not exactly sure why, by the way, from the likes of Vuori and so on, because they don't seem like they're one's perfectly a replacement for the other, but I don't buy stretchy pants for fun, as Nacho Libre said. So, people buy this stuff for me if I'm going to have it. It ends up in my Christmas stocking or whatever. So yeah, that's where I'm at. So I guess I call it a pair of twos. But it's still a Holly index name, which if that matters to anybody, it does matter to me, right? Because that's how I determine where people are spending their dough. That's all good. But unfortunately, that growth rate, remember what this was when we talked about this. We talked about this as a pairs trade, and it was a winner. It was a really good winner. We talked about this one relative to Nike. So so if you're going to do it as a pairs trade, I still like that. So that's an important thing to point out as well, is that not every sector you get long has to be a winner if you have an offset. So you got something that's declining, and you want to, you want to be long ON Holdings to be short Nike. You want to be long LULU to be short Nike. You want to be long Deckers or, is it Skechers? The Hoka brand and short. Then, yeah, that makes sense. But like I said, consumer discretionary just seems like it's a little bit of trouble. Okay. Another subject. Chronicle published top 100 Bay Area restaurants. I'm assuming that's what BA means. I'm actually unimpressed. They also have top Marin County restaurants. Any suggestions from you? Word about Hook Fish Company. Okay, so I know a couple of you actually are from the Bay Area. Hook Fish is in Tam Junction. That's in Mill Valley. That's not terribly far away from me. Hook Fish is, so not to be mistaken for Fish & Co., which is in Sausalito, which is just south of me. That is an outdoor dining kind of picnic table-y situation. Good. People like it. As far as restaurants are concerned in this area, there's a new, I forgot the name of it, there's a new Mediterranean place off of Tiburon Boulevard that's supposed to be very good. I like Bungalow 44 in Mill Valley. Buckeye is always a place to stop by. So anybody who comes to the Bay Area, Buckeye is kind of a go-to for us. Nothing novel about the place, but it's good hearty fare. If it's a cold night, that's a good place to go. Bungalow 44 in Mill Valley is good. All right. Oh yeah, Troya. Yes, thank you, Troya. That's the new place. I have not been. Holly has been. She said it's fantastic. She's super excited about it. She went there last week, so it was phenomenal. So, Troya, that's technically in Tiburon. There's some places in Tiburon too. Malibu Farms, which has very nice spot overlooking the bay. If you just want, burger, you can go to Sam's and stuff like that. Although I'm not sure that the food's so exceptional, but the atmosphere is nice if it's a nice warm day. And then Bungalow Kitchen is over there, but that's very loungy. I don't want to sink down into a sofa while I'm trying to eat my dinner. So that one is, that's a Michael Mina restaurant. So the food is good and it's got great views, but I don't want to be eating my dinner sitting in a lounge chair. Okay, for the CSX risk reversal trade from the other day, do you put in an exit price for the entire combo or for the specific legs? This is my first try at a risk reversal trade. Great question. So let me just, this is, so this will depend on a couple things, but let me just bring something up here and let's see if we can come up with some ideas. When you do a risk reversal trade, you have three legs on. Call spread risk reversal, short put, long and call, and then short a higher strike call. You can unwind legs of a trade as you go. Let's come up with an example. I'm actually going to put SPY in here because I'm going to use really short dated options to sort of provide the example that I'm going to talk about. But if I'm long the call spread and the stock rallies, okay, so I'm just going to build a call spread risk reversal here. Bear with me so we can just talk about this. So let's just say it was something at the money-ish and up 5%, which is going to be 630-ish. And this is going to be short dated, not 57 days out, because actually the purpose of this is to illustrate what you do as time has passed. So we're going to use a really short dated expiration. This is not a trade to get into. This is going to be used as an example of how you manage a trade that you are already into. Okay. All right. So let's say you put it on and it had 40 days to go. There's 16 days to go. And now we find ourselves in a situation where, okay, so this is how you might have structured it, at the time in terms of strikes. But now let's say that it has rallied, okay? So now you're actually going to be long an in the money call option. Okay? Let's say we did this when it was, we'll call it $15 lower or something like that. So maybe you owned the 585. So in terms of percentages, you were trying to line it up, if this makes any sense. So it was sort of like this, and this would have been more like a 560 put. Okay? So hopefully everybody is kind of following along with what I'm doing here. So a couple of weeks ago, you put on a call spread risk reversal in SPY back when it was about 585. So you bought the 585 calls, you sold the 615s, and then you sold the 560 puts against it. Probably put that thing on at, a nominal amount of premium. Now everything's gone great, right? So SPY has rallied. So we're now through our long strike. We're approaching our short strike. And that put is now considerably out of the money. We'll take a quick peek here. I'm looking at my screen to see how well you guys can see this. I'm going to try to move this around so you guys can see what I'm looking at. Oh, did I just screw up that strategy? I think I did. All right. Well, this is going to be a little easier to read in any case. Maybe we can take down that lower... oh, no, we don't need to take down the lower third. Okay. Fortunately, this hasn't been so long that I can't remember what I was just talking about. So it was the 585, 615, 560. So remember, the idea is that you had put this on, this underlying has rallied. How do we manage it? And, you can still also imagine that it doesn't necessarily have to have gone for you. Could have gone against. Okay. So let's take a look at how this trade looks now. If you're using a tool like this one, you're going to be able to see what the risk-reward relationship looks like all the time. If you, by the way, you loaded it into your portfolio, if you happen to use options play, you can just click on it and it'll repopulate the trade, and you'll see where the trade looks at this time. And as you can see here, this is not an exceptionally exciting risk-reward relationship now. So basically what's going on, it's okay. There's nothing wrong with it. This behaves essentially like stock around spot. And then you're capped on the upside, and then you're capped on the downside. The real question you have to ask yourself is, what am I getting? See how you'd get more risk to the downside here? What am I getting for that? Well, the answer is, what you're getting is only 90 cents on a $600 underlier. Watch what happens to that payoff if I just get rid of this. I basically just got rid of the tail risk. 90-cent option. Cover it. You don't want to keep that thing there anymore. And in fact, 90 cents on a $600 underlying is not a huge benefit for being short these upside calls either. So then you might say, well, I might as well just be long this sucker right here. And that's true because, now we're close to $600. This doesn't have a lot of extrinsic premium, right? So you probably want to, when those cheap wing options just decay away, you can take those off. And now what do we have? So $1.80, all right? So how much did you just pay to own those things? You just paid $1.80. That's 30 basis points, okay? That's 30 basis points of the underlying to have two sets of risk. One, that your upside is capped if this big tear we're on goes away. And the other, so that you limit some of, you can limit some of that downside risk that you otherwise would have taken from the short put. You're not taking a huge amount because you're you have a little bit of a buffer. So cover those, right? So as you're dealing with these, just monitor the position each day and say, how much do these incremental legs really help me? And then adjust accordingly. This thing, like I said, we're close to, so we're $10, $11 in the money. So there's $4.20 worth of extrinsic premium in these things. Not terrible. And if you really want to, you can always just roll this sucker up too. And just say, you know what, I'll pay a little bit more. So maybe I'll just, do something like that. So I just took off some of my downside risk. Now I'm adding, what am I doing here? I'm taking away some of my downside risk in exchange for having a higher break even, because like I said, there was not a lot of extrinsic premium before. Now I'm dealing with 600, so the break even got pushed up a little bit, but that's one way to manage it. As it moves and as time passes and the wings on those risk reversals get cheap, buy them back. This, by the way, is also kind of consistent with what the guys at Tasty always talk about on these short strangles. They say with only 21 days to go, buy your strangles back and maybe roll or move out. The whole idea there is that these really teeny options, that are fractions of a percent of the value of the underlying, are you likely to get assigned on those? Not particularly. But is it worth it? Yeah, probably not. That's what we call picking up nickels in front of a steamroller or an oncoming train. We're talking about CSX, so train, I guess, is the one we want to talk about. Okay. I'm happy to help with the unusual Whales coupon process. Anybody has any continued problems with that? If you go all through those steps and then you get to the payment page and you're not seeing a discount reflected, ping us and we'll inquire again. But they walked through it and it seemed to work, so I'm assuming it still does. Okay. PC, could you go over why you are with Interactive Brokers and what kind of account you have and the advantages? Reasons I'm with Interactive Brokers. Well, first of all, because I've had that account for a long time. A pretty long time. I don't actually know when I first opened the Interactive Brokers account. It was more than 25 years ago, I'm pretty sure. Think about that. I can remember logging onto that account from my apartment on South End Avenue in Battery Park City when I lived in Manhattan. And I had not yet met my wife. And we've been together for 20 years, so, it's been a while. So I guess the first reason I'm with Interactive Brokers is because some of the ones that are out there now didn't exist, and I just haven't switched. So that's the first reason. I have a customer portfolio margin account. I think I had an advisor feature attachment at one point so that I could advise others. I don't know if they do that anymore. So they used to have this concept, it was like friends and family, where if you had friends or family that wanted you to manage their affairs and they also had Interactive Brokers accounts, they could assign you privileges of various capacities to manage their affairs. And so I had that. Interactive Brokers is also very convenient if you want to get into the business. So it's very turnkey. They can give reports. They can collect fees from clients. They can charge performance fees. The other thing is that it was a platform that when I was at Cantor Fitzgerald, we used it as a backup to our own, quote, pipes. And what I mean by that is we had different routes, different connections. And we had what was called an order management system. This probably does not matter. I'm sorry for going down this little rabbit hole. It doesn't matter to you. But we had an order management system. At institutions, those are typically separate things. So you don't have one terminal like a Thinkorswim account and you log on and everything happens. You have your Bloomberg terminals. You have Fidessa, which was our order management system. We have routes. We have our own exchange connections. We have connections to what are called fix hubs. So sometimes we have point-to-point direct connections. And all of those systems have to work together. And out of them, we would connect to other brokers and sometimes connect directly to exchanges and things like that. Well, interactive brokers was the system that we would use if all of that fell down. So essentially, if our systems broke and I could not get onto my Fidessa, if I could not go onto Bloomberg and send an order via EMSX, if I needed to have something where I could get on a laptop, plug into an online broker, and fire a trade to the street and put our give up in, Cantor was self-clearing, so it would be 696, and just have it hit our sheets, that was the one we used. And I had some faith in it because when I was a floor-based trader, there was another market-making firm. It was one of the first ones to use technology down on the floors called Timber Hill. Timber Hill was Tom Petterfy's market-making division. That's the same firm as Interactive Brokers. So they actually had people on the floors. So, when it came to worrying about whether an electronic system could go down, there was some value in saying, okay, well, it's a redundant set of pipes through completely separate channels. It does not rely on our existing OMS. And if things really go sideways, we can get on the phone and call somebody and have them go into the pit and do something. So that's why we used it. And the rest of that is habit. But, it may not be the most intuitive platform anymore. I'm not recommending it per se. That's the one that I use. Tasty is built by traders for traders. I don't necessarily, I'm not close friends with everybody over there, but, they've done it a couple of times now. I'm sure they built a solid platform. And I'm sure that's true for some of the others too. So not trying to promote one over the other. You're asking me why I use interactive brokers? That was the long-winded reason why. TLT, this is, it seems like we're getting a lot more. So Kamal Gupta is asking here, do you think TLT goes up or down this month and the next 3 months? Thanks. Here's the big driver. It does seem, it's funny. A little sidebar. At the beginning of the year when we have to do these acronyms for CNBC, the first one I came up with was Bond Vigilantes. That was the acronym I sent them. I sent it to the producers, and they came back and said, you can't use Bond Vigilantes. That's way too long. But it was my overarching theme. My overarching theme was, and as Mark Guthner has pointed out on many of the live streams too, that, at a certain point, you get into a situation where, whether because their preferences are changing or maybe because their circumstances are changing, the lenders of last resort to the world's biggest borrowers, including the United States, are going to run out of patience or capacity. And when they do, you're going to get into a situation where you have problems. The 40-year bull market in bonds is over. It is absolutely over. So let's just take. Now that doesn't mean that we're going into a bear market, but I want to just. Oops. Well, I just killed that screen by mistake, I think. So let's just take a look at 10-year rates here for a second, so that we have some context. This is what I'm talking about. So we had Paul Volcker in here breaking the back of inflation. And as he did that, we got into this thing here. Okay? Rates just went down for 40 years, declining rates. And I think everybody can see, I don't know, you can pick where you want to draw this trend line yourself. I'm not sure that it matters, but it's clearly broken. Now, the other thing I want to point out, and I've said this before as well, and that is that these really low rates that we saw here, and I'm going back to September of 2007, because that's really when the great financial crisis broke out. The equity markets didn't fully recognize it until a little bit later, but this is when things started to break. This is also what caused this, that the solution to everything that ailed us was print money, print money, print money. and the Fed would just buy whatever got issued until inflation came back. And then all of a sudden you realize, oh, wait a minute, we can't do that. That's right. Printing money has consequences. So I think anybody who's banking on bonds getting long TLT because you're hoping that we're going to get back into this, don't count on it. This was unprecedented. The other thing is, don't forget that $1 trillion of U.S. Treasuries is held in Japanese hands. And Japan's got its own problems. They have even more debt than we do. $8 trillion, 250% of their GDP, and their rates are going up, and that creates real problems. So, we're taking these marginal or incremental buyers out of the treasury markets, and even ignoring that, the next question is, why should they be lower? So, what should those rates be? Now, this is something I meant to mention, so I asked the producers, remind me, get back in my ear, there's something else I want to talk about. The Dean Evaluation. Aswath Damodaran, also known as the Dean Evaluation at NYU. He came up with an interesting thesis. Was it earlier this week, or it might have been late last week? It was brought to my attention by a guy named Michael Riley. Michael Riley was a floor trader on the American Stock Exchange many years ago. We were both Red Room guys at the time. He worked for a firm called LetGo. And, he subsequently, I think he ran for Congress in Rhode Island. In any case, I guess he knew Aswath Damodaran, and what Aswath was saying, which I thought was kind of an interesting take, is that after the U.S. Treasury downgrade, so when the credit rating agencies downgraded U.S. debt, what that meant is that U.S. Treasuries are no longer the risk-free rate. This has some important implications. Let's think about that. If treasuries are not completely risk-free, then the interest rate they bear has to be some marginal amount higher than the risk-free rate. Stands to reason, right? So people demand higher rates of return for riskier investments. If it is not risk-free and the credit rating agencies have downgraded it, so they're saying it is not complete, they're saying it is very, very, very low risk, but that's not the same thing as risk-free. That has two important implications. The first is that you can't get back down to those, so the real rate of interest has to be lower than it ever was to get back down to those prior lows, because this is going to maintain some yield premium over the risk-free rate. That's the first thing. What's the second thing? The second thing is, what this tells us is that the risk-free rate is not 435 basis points on the 10s. That's the U.S. Treasury rate, which is very, very, very low risk, not risk-free. If the risk-free rate is actually marginally lower, then what does that do to all asset prices? The lower the risk-free rate is, all else equal, the higher the value of other risk assets, right? So, yeah, I'm not a bull on U.S. Treasuries. I would much rather, first of all, you can do better than this if you have, trip Bs of 4 to 5 years. So less duration, higher yield, still, very acceptable levels of risk. I would much rather see people invest in that area on the curve at better rates. Don't bank on 10-year Treasury rates going back to 2% or anything like that. Finwest says, I love Interactive Brokers. Been with them since 2001. They send me a thank you every year on my sign-up anniversary. Have they ever sent me a thank you on my sign-up? One of the producers who has an Interactive Brokers account says, hey, I haven't got one of those. I don't think I've remembered getting one either. Interactive Brokers, what gives? How about a thank you? Especially since the Interactive Brokers, when I was, running the 40 Act fund, actually, maybe that's the reason they weren't giving me any thank yous. I wasn't very active in terms of my own trading in my personal account. So here's the thing, as probably many of you who have been in the business will know, is that it's not that easy to trade in your personal account when you trade for a living. And the reason is because you have to get prior approval. So you have to submit an approval, compliance says yay or nay. The only exception is you can trade ETFs and stuff like that. And then oftentimes you have to answer questions about it. So running the 40 Act funds, and besides which we're trading, we're trading client money, or we were trading the bank's money when I was on the sell side. And so I couldn't trade that much in my PA. So maybe that's why they're not thanking me. I'm not generating huge returns for them, because all of my trading is on the professional side and not on the PA side. Don't know. But I do like, the other thing you can do with them, and I'm sure this is true for others too, is that you can tie in, your spreadsheets, so you can upload basket trades. They actually have a basket trader function. I don't necessarily encourage people to use it. I had some ticklish things happen with the basket trader, but there's a lot of things that you can do, to sort of customize your workflow with Interactive, which is kind of helpful. And they have different commission schemes. So if you want to have a more of an institutional approach, which is cost plus, you can do that. If you don't want to pay commissions and you're comfortable letting them do whatever it is they want to on the routing side, where they're going to try to maximize PFOF and rebates and things like that, you can elect that as well. I much rather pay the money personally. If you guys ever find yourself in this situation, everybody can pick their own poison. I would much rather do it on a cost plus basis. I want transparency and I want control on how my orders are handled. And if that means I have to pay 17 cents a contract or 25 cents in rebates for the SPX, whatever it is, I'd rather know what I'm being charged and where I'm paying than have it go into a black hole and it gets routed around and they maximize it and I don't really know, who got what and where. So, again, all up to you guys. Michael Kane, thoughts on CrowdStrike after today's earnings news? Would you be a buyer? Well, first of all, adhere to my suggestion. Adhere to a 3-day rule, right? Let it wash out a little bit. See what's going on. Because you have to figure out whether some of the institutional holders are strong or weak hands. And so, 6% in some stocks, that would probably be a pretty big discount. In, say, Kroger's, that might be a big discount. In other names, it's not as much of one. This would be an example. So the higher the multiple on the stock, sort of, the more uncertainty we have about that valuation. You got a stock that's trading 150 times earnings, 6% discount. Is that a big sale? Well, not by my book. I'd sit this one out for a few days and wait. What's going on with Broadcom earnings? They're late? Late? No. They report tomorrow. Broadcom earnings are June 5th. So that's, unless my calendar's totally off, that's tomorrow. Yep. So hey, anybody who's thinking about Broadcom, if you got another day, because they actually report after the close tomorrow. And read up about this, their switch chip, because I think that's pretty interesting. And also the UnitedHealth article, and the culture. This is one of the reasons why it's really important to pay attention, and I didn't, where UnitedHealth was concerned. I didn't realize this guy was literally phoning it in from London. I don't think that's a good way to run a business. But one good way to run a business is to try to do things on time. And I've chewed up an hour of all of your time, which I greatly, greatly appreciate you guys who have stuck around for that. New phone case, you say. Sheesh. Are you talking about a new phone case for me? I actually need a new phone. This is a 12. My wife just got a 16. She replaced it. This thing's kind of shot. So maybe the next time you guys tune in, I'll have a new one. Until then, thanks for watching. Tune in on Friday, Office Hours with Professor Mark Guthner. Thanks for watching.